Now there could be services which are being rendered outside UAE to outside entities, and then there's a concept of withholding tax. So now looking at what is withholding tax. So withholding tax concept is in case, like, a non-resident person in India, company A is trading in the dealing in the electronic items, supplying it to UAE, and it doesn't have a permanent establishment, doesn't have any branch or any kind of legal setup in UAE, but it is dealing through a resident person or an agent in UAE, helping in distribution. So the income which is earned by that non-resident person of India, home UAE, so there's a withholding tax. Fortunately, currently the withholding tax is 0%. So ultimately, that non-resident is not paying any tax, when he's selling out this electronic items in UAE. So 0% tax is there. And now currently since it is 0%, so there is no credit of withholding tax. So credit of withholding tax would be only applicable when the withholding tax is like more than 0%. It could be 2% or 3%. The future, the government authorities can come up with different tax rate in that scenarios. So then the withholding credit of withholding tax will be applicable, and it would be applicable, like, maybe right now they don't have any branch, the Indian entity doesn't have any branch, it is dealing with through an agent who's going to help him and the distribution of those items. But later on they plan to have a branch which is a permanent establishment, or they want to have a setup of legal entity there. Then whatever the withholding tax has been deducted in future when the rate changes, then they can adjust off against with their tax liability which they when they pay in UAE. Then there's another concept of foreign tax credit. So now a company in UAE is supplying the material in Oman or doing any services in Oman, and in Oman we have 10% with tax withholding tax. So any tax liability which is paid in Oman, that can be set off against the tax liability in UAE, which the company would be making. So company A who's supplying in Oman and there's a withholding tax in Oman, then that tax which is paid in the Oman can be adjusted against the tax liability in UAE. But then they need to collect that withholding tax certificate, and until now, those tax which is paid outside UAE is considered as an expense. But henceforth, when the corporate tax is applicable for them, that can be claimed as a deductible out of adjustment out of the tax liability in UAE. So here's an example for that. There's a revenue of 10 million in UAE entity, and after deducting the expenditure, the taxable income is 2.8 million. Now, on that 2.8 million, the company is going to pay tax beyond 375,000, which is 2.425 thousand. On that, 9% tax liability is 218,250 is the tax liability. Now, if the company A has paid some tax outside UAE, which is suppose like 10,000, then that 10,000 can be set off against the tax liability, which is 218,250. The balance net tax payable is 208,250 is the tax payable in UAE. So that adjustment can happen provided the tax is applicable in UAE and it is paying something also outside UAE. So the net tax liability can be adjusted in UAE.